Good evening, everyone. Thank you for joining us on this beautiful June evening. We know that there are other places you could be, so we really appreciate you joining us tonight. We are going to get started because your time is valuable, so we want to ensure that we are not taking advantage of that. Hopefully, we will have some others joining us throughout, but if not, then we are going to have a good time together with you. My name is Sherry Shannon. I am a certified financial coach here at the University of Illinois Community Credit Union, and I'm excited to have two of our newest members of our team join me tonight for our wellness webinar. So, Kelly?
I'm Kelly Odoms, and I'm a member success liaison with the partnership program team here at U of I Community Credit Union.
Hi, I'm Jade Campbell. I'm also a certified financial coach here at the credit union.
So before we get started, just a few housekeeping things. Number one, this is your time, so we want to ensure you're getting the most value out of this webinar. Feel free to post questions, comments, share stories in the chat, or feel free to open up your mics at any time. All right, we are going to go ahead and get started. Hopefully, my slides are going to work for me. I will tell you all, we are using a brand new AV system here at the credit union. So hopefully everything will work as planned. So far, we've been very lucky. So tonight, we are going to talk about consumer spending, going to include some summer spending tips and tricks in there as well. And we're going to talk about consumer lending and do some talks about mortgage loans. So before we get too far into it, I am going to shut off our camera so that we are not distracting for you throughout the presentation. All right, so let's get started. Oops, I went too far. See, already. All right. All right, summer spend planning. Some things to consider when we are planning for our summer is vacations, summer childcare, meal planning. How many times do we forget that we've got kids who are hanging out all summer long, right?
Absolutely.
And activities with family and friends, and extra parties and holiday events. So I really am looking for you, Jade, to share your recent experiences. And Jade's a mom and also just got back off vacation. So has some great tips to share on how we can plan for those events. And really, these are things that we can help us all year long, whether it's not just in the summertime, but anytime we're planning a vacation, we're planning for childcare, we're planning to have the kids home for extended periods of time. So activities and year-round events as well.
Yeah, so true. I find that, yes, obviously I do meal planning and I'm planning for vacations throughout the year, but I do find that I spend more money in the summertime. I don't know if that's relatable for anyone else, but in my house, we spend more money, both on vacation and just having the kids home more because I have a 16 and a 12-year-old. They're very hungry. So they're eating a lot. My grocery bill goes up in the summer. They want and need more entertainment because they don't have that structure of school. So they're thinking, Mom, what am I going to do? And, some of the things, that come up for families with kids are things like summer childcare, summer camps, which is occupying some of their day, but there's even more daylight hours. So, I find at my house, it's light till almost 9 o'clock right now, and my kids are up later and they need more things to occupy their time.
Absolutely.
So they're asking for let's go make an ice cream run or let's go buy a slip and slide because we want to just do something fun in the yard. So we spend more money in the summer.
Right. And so we really need to plan for those. And so maybe this information, you're thinking, oh man, I wish I'd known about this a few months ago. And that's okay, because now you can start thinking about it for next year or for those events that might be coming up as well. So just great tips, Jade. How about your
Vacation.
vacation?
Yeah, vacation's really the big spend, and that's something I do plan for throughout the year. I try to set aside money every single month, have a special savings account, for that, because I know we really prioritize vacation. It's creating memories with our family, and it's a huge priority for us. So I just set aside money throughout the year. But going on vacation, there's so many logistics that you have to think about. Of course, you're stepping away from your own home. So some of the things I find that our water bill is a little bit lower if we're gone for a week or two. It's like, oh, my water bill went down. Of course, I made up spending that money somewhere else. But just as far as where are we going, how are we going to travel there? When we get there, where are we going to stay? Are we going to stay at somewhere a little nicer, maybe a little more budget friendly? Vacation too doesn't always have to be a big production. Maybe it's just a weekend away. It depends on what your budget will allow for, of course. But then while we're there, what activities are we going to do? Are there free activities that we can do? Are there museums in a particular city? And are there certain days where that museum might have free admission? So I try to plan ahead for those things, because like Chicago, for instance, there are certain days where those, Museum of Science and Industry or whatever, that's got a free admission day. Field Museum has a free admission day.
I
Yeah.
didn't know that. That's great.
Yeah.
Good to know.
So a lot of cities are like that, but then even things like if you go somewhere where, nature is very prevalent, you've got outdoor activities, that doesn't always cost as much either. So just thinking about, the cost of traveling somewhere, the cost of the activities that you're going to do while you've traveled somewhere. Are you going to need to rent a car, or can you take public transportation, trains, different things like that. So just all those things. But a big expense on vacation that I have found is food, obviously.
Oh, yeah.
And that's something you really
That's
can't
true.
escape.
I agree.
So
I agree. Yeah, and you really can't, but there are ways that you can kind of help alleviate those expenses, depending on where you stay, right? If you are staying in a hotel, sometimes that's hard. But if you're doing an Airbnb or a VRBO, or if you're part of a timeshare, something like that, where you have a kitchen or some kind of kitchen available, you can at least maybe do breakfast and lunches, or snacks and things like that. You have a place to store all those things, prepare those things. So it does help. That can help on the cost of food.
yeah, we actually did that on our recent vacation that we took. We stayed at a hotel, and the room actually had a kitchenette, but it had a full oven and a refrigerator.
Mhm.
And some people really do not like to prepare meals on vacation. That's not me, because I try to be very budget friendly regardless of if I'm at home or traveling. So we actually went ahead and bought a few meals that we could prepare. And of course, the hotel did have free breakfast included, which it was a nice.
Makes sense.
Yeah.
So that's a big help too. You never know if the free breakfast is going to be kind of skimpy or pretty decent. But we did. We prepared several meals just to save a little bit of money on that trip. So.
Oh, I think great tips, great ideas. Thank you, Jade, for sharing those. And for our listeners, if you have tips that you want to share or experiences that you'd like to share, feel free to pop those into the chat. All right, moving on. So we just did talk through a lot of this stuff, these examples, but just you're going to get copies of these slides for your viewing and consumption as well, and to have for future reference. But just some other things that thinking about where you're going to go, where you're going to stay, how you're going to get there, what are you going to do, what kind of food you're going to need, and don't forget about souvenirs.
Souvenirs are huge.
Yes, that expense, especially if you have kids. Kids love souvenirs. And emergency funds. You never know what could happen. And you want to have a little bit of extra set aside to cover any unexpected expenses. All right. And then meal planning. Let's talk about meal planning. Isn't just for the summer, but in the summer and around the holidays, we always have a larger expense when it comes to meal planning and groceries. And so just a few tips to think about. Planning for those weekly and bi-weekly meals, thinking about breakfasts, lunch, and dinner. And if you've got kids, get them involved in that as well, because you don't want to spend a lot of money on things that they're not going to eat. And I don't know about you guys, but I know my grandkids, they, one week they like something and the next week they don't. And so there's, my daughter and daughter-in-law and son cannot predict what the kids are going to want. They have to have them have their input. So I think getting your kids' input is really important. Make that shopping list based on your meal plans, and budget for those fresh produce, meats, and pantry staples. If you live someplace where you have access to a farmer's market, I know Champaign here, we have one. In Danville, we've got great farmer's market. So if you have access to a farmer's market, take advantage of that fresh produce. And a lot of times it's a lot less expensive
Well,
than
and
what
also it's in season right now.
And it's all in
So
season.
strawberries, blueberries, raspberries, my kids are
Yes.
unfortunately, they don't always eat the healthiest, but right now with everything being in season, you could also grow your own garden too.
Oh, yes,
Yes, a lot of
absolutely.
people are doing
Yeah,
that.
and if you are one that loves to garden and do that, take advantage of this time and grow as much as you want.
Another thing I like about involving the kids with the meal planning, it gives them a little bit of ownership over it so that so I'll tell my kids, well, you picked this out, so you have to eat it.
Right.
But also I like to include them with the shopping as well, because that gives them skills for later on to see how much things cost and budgeting and meal planning. So they can see that it doesn't just happen and come together. There's work that goes into it to have, the meals for the family for the week.
I think that's great, Jade. Thank you for sharing that. That's really important.
Yeah, I would also say, don't be afraid to buy in bulk. If that works for your family, consider buying in bulk. And then when you are able to get home, separate those meals and freeze what you need to freeze, and make sure that you're planning accordingly so that you always have something in your refrigerator that's readily and available for your kiddos to grab, or for you to pull out and thaw out and cook for dinner that night.
I think that's a great tip. And it reminded me of something that someone shared with me. Maybe you don't have the ability, you don't have the need for bulk, but do you have friends? Do you have family where you could share those expenses? And so going in together and buying those items in bulk and then just splitting them up, I think is, with family and friends as well. And if you're thinking about dining out, now I know a lot of times this time of year, especially if you have kids and they're busy with sports or events, eating out is just something that has to happen because you're busy and you're juggling, and cooking is not always an option. So just making sure you're allocating for those meals. And then also special meals, barbecues, picnics, and holiday meals are added expenses. And I think, Kelly, you had some great suggestions for that.
Yeah, so sometimes when you have planned to have some type of outing, consider, partnering up with those who you're inviting. And if you're hosting, then you know that you're responsible for the setup and the cleanup. And then maybe you all pitch in together to buy the meat for the party. And then don't be afraid to ask those who are coming to the party to bring a covered dish. It just makes it so much easier on the person who is hosting, so you don't feel like you have to pay for everything that's going to be going on at that party.
I think that's a great tip. So we all have activities that we'll be taking, whether we're on vacation, we're planning a vacation, we're planning trips whenever. But, having that allowance for outdoor and indoor activities as well during the summertime, during when kids are at home, you've got the park and pool fees, sports equipment and event tickets. Consider, what are they going to do when the weather's not great? I know the last couple of days, we've had these pop-up showers, and so it does kind of change what's happening with the kids. Or it's been so hot, you really don't want your kids spending a lot of time outside. So what are some of those indoor activities that can take place? I know we're planning a trip, and we're going to be taking our littles up to Chicago for a few days. And my husband's like, it might rain. I said, there's plenty of things that we can do that's inside up in Chicago. Hey, we've got a comment. When traveling, using items from breakfast to make lunch or pack a snack helps save extra, especially if breakfast is free. Oh my gosh, that is such a great tip. Thank you for sharing that. Love that. And I have to say, I know that's one thing my parents do when they travel.
Mhm.
They'll get that free breakfast at the hotel. And then if they're whether they're driving or flying, they always maybe pack an extra muffin and a banana or an apple or something like that to have along the way. So great tip. Thank you.
Yeah, I was gonna say too, when the kids are in summer camps and doing all the things over the summer and you're dropping them off and picking them up, what do they want to do as soon as they get in the car? They're hungry. They want to grab something fast. But one way is to just have something already in the car, a banana or some fruit, or maybe pack some sandwiches so that when you pick them up, there's already something for them to eat.
Well, and that's not just during the summer,
Mhm.
that's during the school year. Because I know my daughter-in-law, when she picks the kids up from school, they want, can we go get a snack?
Yeah, they're
And-
starving. They're always
Yeah,
starving.
they're starving,
Yes.
yeah. And so, having those in the car, I think smart, smart, smart. Other activities that you might want to take advantage of during this time of season are the festivals and fairs as well.
Yes.
So those are coming up, and these are all things that are cost effective, but might have a little bit of cost to them. But just think about how that affects your budget, and do the things that work within your budget.
And when we're talking about, movies and museums and things, something I was thinking of is the cost to go to the movies is really expensive for a family of, four.
Yes.
But what you would pay to go to the movies, you could purchase a movie projector
Oh,
and have movie nights weekly or however often you wanted to, right in your backyard.
and just get a big white sheet and
Yes.
string,
Yeah.
set up oh,
Yes.
I love that.
Yes.
That's a great idea.
and invite the kids from the neighborhood or other families to come and
Yeah.
take part in that.
Because their kids are going to see that, if you live in a neighborhood with there's other families, or kids, they're gonna see, ooh, can we go over there?
Yes, yes.
Maybe you could even share babysitting. Maybe you
There you
rotate
go.
who's got the kids on the
There
particular.
you go. That's a great idea. So Baja is full of good tips tonight. Thank you, Baja. Savoy 16 has $5 Tuesdays.
Ooh,
$5 Tuesdays.
Well, there you
Great.
go. That's a great tip. Thank you. All right. All right. Let's talk about, so sometimes we get into this area where maybe we've planned as well as we thought we could, but maybe we're falling short on something. Or at some point in time, I know right now at home, we're going through an issue where our air conditioning keeps going out.
Ours
So-
just went out, $500.
Yeah, and so, our upstairs went out, we had to replace the upstairs. And then a fan motor went out on the downstairs, and so we're replacing that. And so those are expenses that we might not be prepared for.
Mhm.
And so this is where we can take advantage of lending. And so we're going to talk a little bit about what lending looks like. We're going to do some kind of lending 101 for you. So specifically talking about consumer loans right now. What are consumer loans? Well, they're loans that are available to our consumers. There's two specific types of consumer loans: revolving credit consumer loans, which are credit cards, lines of credit. So these are things that you can access on a continuous basis. You use them, you pay them off, you use them, you pay them off. If you're a homeowner, you might be familiar with a home equity line of credit. There's installment credit, and these are loans that have an end. That once they're paid off, they're done. You never access them again. And those examples are auto loans, personal loans, student loans. To dive a little deeper into installment credit, these are loans. There's loans with collateral, so a secured loan. These are less risk to the lender. They sometimes will carry a lower interest rate. You can a lot of times borrow more money, and you have a longer repayment period. A great example of a loan with collateral is an automobile.
Mhm.
And so you can take those out for longer periods of time, get a lower interest rate, and get larger loan amounts with an auto loan. But there's unsecured, and that's an example of that is a signature loan, a personal loan, where you're just signing a piece of paper, agreeing to pay that loan back. Because those are a higher risk to the lender, then a lot of times they do come with a higher interest rate. And you all typically won't be able to borrow as much for those. So thinking of, that emergency where your air conditioning goes out, you don't have the $500 to $5,000 because depending on what has to be replaced, to fix that, then you would be borrowing that as an unsecured because you don't have any collateral for that.
Yes.
And of course, to a shorter repayment period too,
Yes.
because, they don't want to have it stretched out too long, because the longer it takes you to repay it, the more risk potentially.
Yeah, exactly. And as a consumer, you don't want to pay that high interest loan back over a long period of time because
It's
then
gonna cost you more.
it's going to
Yes.
cost you more. What are the advantages and disadvantages of revolving credit? One is flexible borrowing. Your credit card, for instance, you can, if a smart way to use your credit card is use it, pay it off, use it, pay it off, right? But it's there if you have an emergency and you need to purchase something quickly. And it could have a bigger effect on your credit score. But it comes with higher interest rates and inconsistent monthly payments.
That's very important.
This is really important and for you to understand. If you are a credit card user and you don't pay off your balance at the end of every month, you could see your monthly payment change regularly. It's based off of your balance. And so then it's hard to budget for those. And so this is another reason why credit cards, it's really important to only use them if you know you can pay them off at the end of the month. Understanding that emergencies happen, but this is why it's important to do your best to keep those low and keep your monthly payments consistent. So I want to talk a little bit about this secured loan option. And this is something that can has some really good benefits. Mostly if you're trying to build your credit or rebuild your credit. And I know here at the credit union, we offer two options: a savings secured loan or a savings secured credit card. And the way these work is you save X number of dollars, usually $500 to $1,000 in a savings account, and you can borrow against that. And you make your monthly payments, and those are reported to the credit bureaus so that you are building credit. So you do have to make that monthly payment on time, and you don't ever want to miss a payment. And those are all reported to the credit bureaus. The credit card works in the same way. It's just that remember, credit cards are revolving credit. So with the installment loan, you're going to make those monthly payments. And then when you've paid off the loan completely, the money you had securing that loan is free for you to spend as you like. With the savings secure credit card, the savings account is securing that amount, and say it's $1,000. That's your limit on that credit card. You can't use it for more than $1,000. But as you make the payments, that money becomes free again. So both really good options for someone who is building credit or trying to rebuild their credit, because both are reported to the credit bureaus. Anything you guys want to add on
Well,
this?
it's really a win-win for the consumer and the lending institution, because the lending institution is not taking
No
much risk, if any.
Mhm.
Plus, for someone who needs to build or repair their credit, that's happening along the way. So both parties of the transaction feel good about it.
Absolutely. And typically, I believe they come with a lower interest rate than a normal
Yes.
credit card.
Yes.
And so if you are someone who's building credit or rebuilding credit with the secure credit card, usually in 6 to 12 months of usage and paying off on a regular basis, you can apply for a regular credit card.
An unsecured.
An unsecured card, yes.
Yeah, so it really motivates the consumer. You know, if you've just come up on some bad times and your credit has taken a hit, this is a great way to kind of start back up again and try to repair your credit and be able to look forward to, as we all talked about, getting something that is not secure.
Exactly. Exactly. All right, moving on. Here's some terms to know. I mean, so many times I've talked to some of my coaching clients and like, well, I've never applied for a loan, but I don't understand it. And there's a lot of terms to kind of the basics of it to understand. What does as low as mean?
That just means that that is the lowest rate that that lender is offering. But there are still some qualifications that that borrower is going to be able to take advantage of that lowest rate. So that's not necessarily the rate that someone will get. It's just saying this financial institution is offering a rate as low as this.
So the consumer has to meet certain criteria
Yes.
to get that as low as rate. And that's really important to know because all lenders, you'll see a rate that, auto loans at 4.25 or something like that but you have to look for that as low as, and that's really important for you to understand. The other is, what's the difference between fixed rates and variable rates?
Well, fixed rate is not going to change.
Okay.
It's going to be fixed for the full term of that loan. So
Okay.
if you think about that as low as of 4.25 and you're taking out that vehicle loan, that rate is going to stay at the 4.25 for the full term of the loan.
Okay.
Whereas with a credit card, that's going to be a variable rate, sometime based off of prime, and that rate can vary. And so you have to be able to adjust because your payments are going to could adjust as well. So you have to be prepared to make a different payment that could be showing on your statement every month.
Good point. Good point. Yeah. And so it's knowing the difference between those. And those are questions you can ask a lender. What type of rate is this? So what's this debt to income ratio?
Well, that is basically taking your total debt that you have. So your auto loan payment, your credit card payments, your rent or your mortgage payment every month, taking that and dividing that by your monthly income. And that's going to give you a ratio. And that's one of the factors that a lender is going to look at when they're trying to make a decision on whether you're credit worthy of the loan that you're requesting. And so it's important to know what your debt to income ratio is and try to keep that within a certain amount so that you're in the best position possible to get approved for that loan.
This brings to mind something that I want to share with everyone. If you're not familiar, if you have ever bought a home, oh wait, Naomi asked, is there a certain ratio that they are looking for when considering someone for a loan?
Well, that is probably going to vary from institution to institution based on the underwriting guidelines that are set. But a lender probably does not want to see your debt to income ratio more than about 40%.
Okay.
And so I think that's a sweet spot to look at. But every lender is going to have their underwriting guidelines that are going to state what that debt to income ratio should look like when someone's borrowing money.
I think that's good to know. Thank you. Great question, Naomi. Thank you. One of the things I want to share with you as consumers to understand is when we visit a lender, or maybe we're looking at a new car, or maybe it's a new home, and a car dealer or a realtor will
We've got another
They're-
comment to do too.
okay.
Looks like when
they're looking at your credit worthiness. They're looking at how much you can afford, right? But what they remember, they're only taking into consideration if you have a house payment, if you have a car payment, anything that's showing up on your credit report.
So there's a lot of things.
There's a lot of
Don't
things.
show
That
up on
don't show.
So
They-
for instance,
Yes.
we talked about this. We
Yes.
talked about childcare.
Yes,
That's not going to be a monthly obligation that's going to be on your credit report. But if you have childcare expenses, you know that you have to pay them.
yes,
And that can be very, very costly for anyone who's had children, or even if you have grandchildren and you know what your children are paying for childcare. Another one is utilities.
Utilities,
facilities, yes.
Yeah, so
that can
Yeah.
be very expensive.
Yeah, so,
car insurance and things
Uh-huh.
like that. So
yeah. It's-
Those things don't show on a credit report.
They don't. So you as the consumer has to be very savvy and understand that a car dealer or a realtor will say, well, you can afford this much. But they don't know all your other expenses. So be very, very careful, because you're the one that's gonna be making that monthly payment on that car, that home. And so being very aware of what you can actually afford.
Yeah,
Um,
as consumers, we have the power in that moment,
Yes.
you know, and we have to be realistic, and it's very smart to maybe step away from that transaction and go home and really run all of the numbers
Yeah.
to really get a realistic overview of what your debt to income ratio really looks like. And then you can make an informed decision once you have those tools to use and go back and say, you know I'm approved for a $40,000 vehicle, but realistically, I can only afford like a $25,000 vehicle.
That's exactly right. Baja, another good comment. Sometimes student loans are not included in the DTI calculation. That can be true. Yes, that is true. Good point. Thank you. Last one, loan to value. What does that mean?
Well, loan to value is the same way you would figure the debt to income. It's taking the amount of the loan that you're going to be taking out and divide that by the value of that vehicle. And there's a ratio there that the underwriters look at. There's a threshold that they have. Some factors that play into that is the term that you're taking it out for, the year vehicle that you're purchasing. If we're talking about a vehicle loan. So those are all factors that play into the loan to value, the amount of the loan divided by the value of that collateral that you're using.
so both of these are going to give you a percentage.
Yes.
Yes.
Yeah. So
And-
yeah.
And they can affect your overall rate that you receive for that loan.
Yes.
That comes into play too if you're doing a home equity loan, because there are, the percentage can't exceed a certain, there's usually 80 or 90% of the
Yes.
value. So
That's right.
And just like with your debt to income ratio, Sherry, with the loan to value, just because a lender says yes, you can borrow 110% of the value of that vehicle, that might not be the smartest move for you.
Right, exactly. And so as consumers, we really have to protect ourselves and know the ins and outs of lending. That's why I always suggest, yes, you can always go to the dealership and they're gonna help you get a loan right there at the dealership and make things easier. But I would say working with a local lender and who really can sit down and help you better understand what you can actually afford is probably a much safer bet.
Yes, because they're going to look at that overall picture.
Yes.
Yeah,
Yeah.
with you.
They're going to work with you. So when you are considering a loan, things that you might want to consider is, number one, how much do you need to borrow? How much can you afford? This is what we've been talking about. And then using calculators to help you calculate and estimate your monthly payment to ensure that it's going to fit within your spending plan. So I know here at the credit union on our website, uoficreditunion.org, you have access to some really great loan calculators where you can put in the amount you're looking at, the interest rate. And if you're not exactly sure about interest rates, you can look at it as low as, and then maybe increase it a little bit to give yourself some adjustment. And then, how long do you want to take that loan out for? So you can play with those calculators a little bit to kind of get an estimate of what your monthly payment would be and see if it's going to fit into your overall budget. Quickly, we're gonna take a look at, your credit score. And knowing your credit score, we've talked about this in past, if you've joined us, is really important, when you're going to borrow money. Because the higher the score, the lower the interest rate possibly that
Mhm.
you're going to get. There's no guarantees, because as we've been talking, there's other factors involved.
Mhm.
There's your credit score, there's your debt to income, there's the loan to value of whatever you're borrowing. So, but rule of thumb is, a higher credit score, you do have a better chance at a lower interest rate on that loan. But this is where knowing your score can help you if you think you want to, if you're wanting to plan on how do I get into a loan? How do I get approved for that loan if my score is fair or poor? And those secured credit card and loan options are really good for you as well in helping build that. But your FICO score is what most lenders are going to go by when you're applying for a loan. So if you, and I say that because a lot of us like to check our score for free, maybe a Credit Karma. I know Expedia has a free version. I think it's Expedia Experience. Some of them, there's some other free ones out there. I know we have one. If you bank with us, you can go out to your digital banking and you can check your credit score for free. That is a different scoring model, still a good scoring model, but it's called the Vantage scoring model, and it looks at your overall credit a little bit differently. So if you are checking those and you say, okay, my score is this, and you apply for a loan and your financial institution says, this is what your score is, one could be higher than and lower than the other, and you just never know when and which one. And that's why. It's not that either one's wrong, it's just that they're looking at your overall credit a little bit differently.
Well, that even happens if you're gonna buy a vehicle, for instance, and maybe there's a few different lenders because maybe the dealership is shopping it around for you. Different financial institutions use different scoring models, so it's like you said, it could be, everything's exactly the same, but they've picked a different scoring model, and then there's no way to know that until you get into it.
There really isn't. And just know that you're probably going to be within a few points. It's not going to be a drastic change. I want to talk a little bit about credit card usage, because credit cards tend to get a bad rap, and they're really not bad. It's how we use them that can be bad and put us into a bad financial situation. So credit cards are a great way to build your credit.
Absolutely.
And one of the things, though, to be cautious of, that doesn't mean going out and applying for a bunch of credit cards. That means, having a really good mix of credit, having a revolving, so a credit card and maybe an installment loan. Maybe that's a personal loan, an auto loan. If you have student loans, those are installment loans. So just having that good mix of credit. But credit cards can also be that emergency fund. If you have an emergency that you're not planned for and you do have a credit card with available balance, you can use that in that emergency. They're also my personal, and one I recommend to my coaching clients, if you are an online shopper or do any shopping online, purchasing anything online, is using your credit card rather than your debit card. Because your debit card is tied to your liquid funds. These are the funds that you're living off of every day, versus your credit card is not. And if you have fraud, then it's much easier to mitigate that with your credit card
Sure.
rather than your debit card. Kelly, I know you were in member services for quite a long time. Did you experience any situations with members in a situation like that?
Well, yeah, I think it's just so disheartening when you witness someone who's been a victim of fraud in any way. And when it's impacting their finances where, they're not able to pay their rent, or they're not able to pay their house note or their car payment because these funds have been taken out of their account without their approval, without their authorization. And so using a credit card is one way to avoid that, because it is not impacting your liquid assets, your liquid money. You're able to have those chargeback rights through that credit card company. They can get that credit card shut down quickly, and then be able to get you a new card, get that balance transferred while they're investigating this fraud that's on your account. And it's not impacting those funds that are in your account.
I think that's smart. And know that credit cards, this is where if you have to be a little disciplined, is not using more than 30% of the available balance.
Mhm.
And ideally, only using it when you know you can pay it off at the end of the month. But sometimes emergencies happen, life happens, and we have that available. So we use it to help us in a situation. And so just really trying to pay them off as soon as possible so that they don't impact your financial life. Remembering that you have to make those payments on time. You don't want to miss a payment, and you don't want to be late on a payment, because that will affect your credit. And it does stay on your credit report for 7 years. I just want to do one more plug on credit cards, just again, don't have a bunch of them out there, maybe 2, maybe 3, but just being very aware of what you have out there, and that you're keeping your usage below 30%, preferably 10%, is really the preferred, to keep your credit healthy.
Well, and too, before we
No,
switch gears,
yeah,
I think several of us do the rewards or the cash back, because
yes.
if you can, and I agree 100% with just having a couple, because it can be very overwhelming to be juggling. Like if you have 6, 7, 8 to juggle, like, okay, what do I owe? When's it due? I've actually been in that situation before, and I've always kept up with it, but I'm like, this gets a little complex. But if you're able to pay it off every month because you're not paying interest, so you're not eating into what you're gaining, you can get some great rewards. So it's like, if you're able to stick with that and be disciplined, why not get yourself a little extra bonus or boost?
I think that's smart, Jade. And I just want to put a plug. Our rewards card here at the credit union, I don't really use my rewards points for anything other than gas, because if you get gas at Murphy stations, there's Shell stations, HP stations? BP, that's it, BP. Those all you can, if most are participating in this program, but you can get 50 cents off a gallon of gas using my rewards credit card. So and then not only am yes, I'm going to use points, but I'm also going to earn points on that sale. So it all works out. But then we also have the cashback credit card, and you're earning dollars on those expenses. So what I find is, when I'm planning a vacation, I'm booking my travel using that. Because I'm getting 5% cash back. We use it for gas when we're traveling because we're getting cash back. So
What you told me you filled your truck up for?
oh, well, that was with my Meyer
Yes,
points. Yes. Using rewards points are great. And I was telling Kelly that I saved $1 a gallon filling our truck up the other day. So I paid $2.11 using my Meyer rewards points. So
It definitely feels like a win.
yes. And so rewards programs, whether they're tied to a credit card or where you shop, take advantage of them, because if there's something that they're going to benefit you. For us, we use our Myers rewards for our for that for sure. So I think we got a comment here. Let me see. Oh, okay. Naomi, I'm sorry, I did not see your comment earlier. Naomi asked, does canceling a credit card negatively affect your credit score? And
We had audience participation.
Yes, Faja, thank you very much. You caught that, and for us, And she's absolutely right. Yes, it erases your history with that account. So if you are working hard to pay off credit cards, don't close them because you're going to lose all that credit history. The other is if you're worried about, well, I don't want to rack up a balance again on it. That's fine. Keep them out of your wallet. Use them periodically though, because the financial institution that owns that card will close your card if it's not used. So periodically buy some gas, buy some groceries, plan a trip, whatever, use it periodically and pay it right off. Even if you just use it to buy gas and then you pay that off when you get the bill, that will keep that account open. But
Yeah, I had that happen to me twice.
Oh, really?
Where I hadn't used it, and my credit card was closed. They normally send you a letter in the mail, but hey, who reads all the mail that comes in, right? But they had closed the credit card, not because I had not paid them as agreed, but because I hadn't used it in a while. And so that did have an impact on my credit score for a little bit.
Yeah, and it will. So thank you, Baja. We appreciate you. We've got another comment here. Baja asked, any advice on building credit for kids under 18? Depending on what age under 18, I would say a secured credit card or even a secured loan. I think it depends on how young they are. Kelly, what do you remember what the age?
Well, they're going to have to be at least 18 to apply for credit.
Without a cosigner or
legally they
Oh.
have to be at least 18 to apply for credit, I do believe.
Okay. I was thinking we had some changes to that, but one thing that I think has been helpful for a lot of people is giving them as a authorized user on your credit card.
Assuming that you're responsible with that.
Yes, you can add them as an authorized user under 18. I don't know what I was thinking about. Maybe it's just checking accounts. I was thinking about that we offer the checking accounts for kids. So
so our daughter, is in her third year of college, but that's one thing we did was added her as an authorized user, and her credit score really started to go up. She went from a 0 to like over a 700. So that can be done, and that's a good way to do that.
Yeah.
That's how a lot of parents are preparing their kids even to go to that next step. We know when they're going to college is to add them on as an authorized user.
Okay, good. All right, Baja, you're rocking it tonight. All right, come on, next slide. We're gonna try and move on. All right, we're gonna talk a little bit about mortgages. The mortgages, they're used by consumers, they don't fall under consumer lending. They're their own animal. So we want to talk a little bit about the different types of mortgages. We got about 10 minutes left in our time together. Here at UICCU, we are full service lending, and that includes mortgages. And so we offer several different types of mortgages: conventional, FHA, Federal Housing Administration, Veterans Affairs, USDA. And for the veterans and the USDA, there are special qualifications for those. For the Veterans Affairs, that is a military active duty or veteran loans, and those are you can get your financing without any down payment. The same with the USDA, but those are for rural mortgages. And so, but again, most qualify for that 100% financing. Wanted to talk a little bit about other types. We have a rate term refinance of a mortgage. So what that means is that you're refinancing your mortgage, your current mortgage, just to take advantage of either a lower rate or a different term. So, and not necessarily a lower term, but it could be, you may be refinancing to go out longer, maybe some situation has happened where you need to refinance to lower your payment. And so going out for a longer term helps you do that. And then there's cash out mortgage refinances where you're going to refinance your home and you're going to take the equity in that home and use it for something else. And then there's home equity lines of credit, which instead of refinancing your home to get the cash in the equity out of your home, you are actually taking out a loan against the equity in your home. And then with that line of credit, now you can access that money at any time. I've had my home equity line of credit for several years, and it's been great because I'll use it, pay it off, and then if I need it again, it's there. It's available to us. Otherwise, it just sits out there. You don't pay anything for the money when you're not using it.
Yeah, and I've seen people take out a line of credit for anything from home improvements to pay for their child's college, maybe buying an investment property. So it's nice with the home equity loan that the options are available for you to take that out for many different reasons.
Absolutely. And they typically will come at a pretty low interest rate. They're usually based off of prime. And so they're a percentage above prime. Some lingo you're going to hear if you're applying for a mortgage or even a home equity line of credit. What's the mortgage term? So this is the length of the mortgage. So typically, between 10 and 30 years. What's a fixed rate mortgage? Well, fixed rate means the rate doesn't change. We talk, just like with our consumer loans, this rate remains unchanged for the term of the loan. And so a mortgage loan is an example of a fixed rate where when you get that mortgage, that rate won't change unless you refinance. And then the adjustable rate mortgage, or sometimes called an ARM, it changes periodically based on market conditions. So I do believe that I've seen before advertised like a 5-year ARM, which means it doesn't adjust for that first 5 years, but afterwards could adjust, either go up or down. So based on the lender, but these are some standard terms you're going to hear, but just know that they could vary based on lender. Closing costs. So these are any fees associated with finalizing a home purchase. And those will vary by lender, which is why we did not list any out there. But just know that when you are applying for a mortgage, there will be closing costs, and those are just part of the purchase process. And then an escrow account. This is an account that is used by the lender to collect your insurance and tax payments. And so if you decide you want to escrow your insurance and tax payments, that becomes part of your monthly mortgage payment. It's not a separate. And so sometimes this is something you have to do based on how much you're borrowing. And sometimes you have the choice. So a couple of different scenarios in our group that I want to share, like I choose to escrow my taxes and insurance only because I just like having that one monthly payment. But Jay,
Yes, I'm the queen of not escrowing because I do my own escrow account. I have a savings account and I know every month what I need to put into that. And so obviously I get my annual property tax bill and I keep a close eye on that. I'm kind of a money nerd. I just like going and paying my taxes when I want them to be paid, even though it's going to adjust for, if you have the bank or financial institution or credit union, those payments are going to adjust. They're going to adjust for me too, but I just like having that layer of controlling the process and deciding when I pay.
yeah.
So,
And either way is fine. If your lender isn't requiring you to have that and you choose not to, that's fine. If you choose to, that's fine as well. Just know that that's what that's all about. That's what that escrow account is.
Yeah, and I was going to also insert, you may be in a situation like me where I was used to an escrow, but we just paid our mortgage off. And so now this is a huge adjustment for us because we were used to that all just being a part of our mortgage payment. But now that there's not a mortgage payment, we're responsible for making sure that is paid every year by those deadlines. So we've had to make some adjustments in our household to make sure that we are able to pay those when they come due.
And don't forget to pay.
Right, and don't forget to pay them
Yes.
because we're not used to
We've
it.
been spoiled all these years, you know, and now we are doing it on our own. So
Exactly, good point. And then the last is private mortgage insurance, and this is usually required on conventional loans with a down payment of less than 20%. And so a lot of times you can get a loan for 3 to 5% down, but you are going to have that private mortgage insurance added to that mortgage loan. All right, moving along because we are running short on time. Different costs that you can expect on a conventional mortgage loans. These can vary by the type of loan and dwelling, but typically, as I just said, your down payment is usually 3 to 5% of the home's purchase price. And again, you'll probably have to have private mortgage insurance added on to that if you put down less than 20%. For FHA loans, sorry, usually that down payment is 3.5%. As we stated earlier, Veterans Administration loans and USDA loans usually don't require a down payment. Some documents you're going to want to have prepared. Again, this is standard, but it can vary by lender. Definitely your personal information, driver's license, passport, social security number, income verification, W-2s for the last 1 to 2 years, pay stubs. If you are self-employed, you're going to want to provide at least the past 2 years of filed tax returns. And then employment verification. So, you know, just your employer's information, contact information, and then employment history for the last 2 years. Now, this is something I just want to touch base on because I was always under the assumption you had to work at the same place for at least 2 years, but it's been employed for the last 2 years.
consistent.
Yes, consistent. So this is where understanding this terminology is really important because sometimes we can get the wrong information. And then your asset verification. So bank and investment statements, proof of any additional income. These are going to be standard documents that you're going to want to have ready when you get ready to apply for a mortgage. So stages of the mortgage process, I really wanted to touch base on because a lot of consumers don't understand why does it take so long for a mortgage loan to close, which is usually about 30 days. And so number one is you're going through the pre-approval process. I highly suggest this for anyone who is going through. So this helps you understand what you can afford. Mm-hmm. And then once you get that, then you're going to be doing the house hunting and offer. So that those two really are dependent upon you. That time frame is dependent on you. Where the 30 days really starts is once your offer has been accepted and you're starting the loan application process. So even though you've been pre-approved, there's still more that has to happen once you've made an offer on that home. And so that processing of the loan, this is where your information is verified, and that takes anywhere from 1 to 2 weeks. The underwriting, that's a detailed review of your application, and that can be 1 to 3 weeks. And so all of that usually will take about 30 days for closing.
Yeah, keep in mind on that pre-approval is only going to be good for so long.
Right. Is it 30 or 60 days?
I think it's about 60 days now. But,
okay.
But it's very important that you're very serious about moving forward with finding a home because at some point in time that pre-approval could expire.
Good point. Thank you, Kelly, for sharing that. Mm-hmm. All right. In addition to your mortgage loans, we want to talk a little bit about the home equity difference is a fixed rate home equity loan. Again, fixed rate provides that lump sum of money at one time at a fixed interest rate, and fixed monthly payments. And the home equity line of credit, again, is that revolving credit line. And so you can borrow and repay, borrow and repay. So your interest rate can vary on that, and your payments are going to vary on that as well. And we are at the end, and we are right at 7 o'clock.
Yes.
Thank you guys so much for joining us tonight. We really hope that this information has been helpful. We really appreciate all the questions and comments, and watch your email. We will send the recording out to you probably beginning of next week. So everyone have a wonderful evening, and we hope you'll join us in September for our next event. Have a good evening, everyone.